What is the stock market? The stock market is a financial marketplace where trading of publicly held stocks occurs. Stock markets allow stockbrokers, investors, and traders to buy and sell stocks of publicly traded companies. It allows companies to go public and raise money as well. A share represents part ownership in an organization, and individuals who possess these are called shareholders. A company should be listed in the stock market for its shares to have legitimacy. The total share value of a company is known as the market cap. The size of the stock market is dependent on the market capitalization of the shares of these listed companies. The current market cap of the Indian stock market is $3.31 trillion. The US stock market, on the other hand, is around $93.7 trillion. As of 2022 December, the stock market plays an essential role for investors as an avenue for investing in publicly traded companies with the potential for profit and earning returns on their investments. Investors buy or sell stocks through this medium, while prices for stocks on this exchange are determined by supply and demand factors. It also serves as an indicator of both overall economic health and individual companies' or industries' performances. What is a stock exchange? A stock exchange, commonly referred to as a bourse, is an international marketplace where securities such as stocks, currencies, commodities, and bonds are traded among buyers and sellers. Stock exchanges are either physical or virtual and are generally composed of brokers, dealers, and market makers who facilitate buying and selling securities on these exchanges. They are generally governed by government agencies that set forth rules and procedures for trading at these exchanges. Titles within the stock exchange include brokers, traders, and market makers. Brokers act as intermediaries between buyers and sellers, while traders buy and sell securities for themselves. Market makers facilitate trading by providing liquidity, making sure there are always buyers and sellers in the market, thus facilitating the trading activity. The traders will be able to buy these stocks by taking a position in the stock market. They can also sell the stock when you exit the position. Traders usually trade 5 major types of capital market instruments. They are equities, debt, derivatives, mutual funds, and exchange-traded funds. The functions and advantages of the stock exchange include providing an avenue for companies to raise capital, providing investors with a way to buy and sell securities, and serving as a mechanism for price discovery. Other benefits of trading on an exchange include increased liquidity, transparency, and efficiency when trading securities. Instruments traded on the stock exchange include stocks, bonds, and other securities, such as derivatives, such as options and futures contracts that derive their value from an underlying asset. Stocks represent ownership in companies, while bonds represent debt issued by businesses or governments. Other securities include derivatives like options and futures contracts, which derive value from this underlying asset. What are the responsibilities of a stock exchange? A stock exchange serves functions that facilitate trading securities in an equitable, transparent, and efficient manner. One primary responsibility is identifying which securities qualify for trading on its platform. This involves listing and delisting securities based on specific criteria such as financial reporting requirements or minimum market capitalization thresholds. Stock exchanges provide investors with a central marketplace for trading securities, providing access to a large pool of buyers and sellers for buying or selling. This platform facilitates price discovery. Price discovery is the process by which market prices of securities are determined through supply and demand forces. This helps investors have access to accurate prices of securities traded. Providing fair and transparent trading environments helps stock exchanges ensure accurate pricing. Regulating trading activity is another core responsibility of a stock exchange, which includes setting rules and regulations to guide trading on its platform and ensure fair, transparent trade that is free from fraud or manipulation. Stock exchanges also offer real-time market data and information to investors, which assists them with making informed investment decisions and increasing market efficiency. This may include providing price information about securities, as well as other pertinent market details. Stock exchanges also play an integral part in the economy by helping companies raise capital and investors allocate funds, benefiting both individual investors and companies that participate. The stock market should provide the traders and market players a seamless and strive to achieve a flawless trading experience. This is possible only if it ensures that every market player follows the regulations and rules set, and also provides transparency in how they achieve it. What types of securities stock exchanges covered? Stock exchanges provide access to assets such as stocks, bonds, and other financial instruments. Below are more details about the three major types. Stocks. Stocks represent ownership in a company and are traded on stock exchanges. Their price depends upon market forces of supply and demand. The general consensus with trading shares is to buy them at a lower cost and sell them at a higher cost to earn profit from the price difference. Bonds. Bonds represent debt that companies or governments issue. Investors essentially lend this money back with interest at set intervals to the issuer of these bonds, who then repay investors over an agreed-upon timeline. Bond prices on stock markets fluctuate depending on supply and demand factors, similar to stocks. Derivatives. Derivative financial instruments which are traded on stock exchanges include options and futures contracts that derive their value from an underlying asset such as stocks or commodities. Preferred shares. A hybrid between bonds and common stocks. Pay fixed dividends like bonds, but represent ownership like stocks. Traded on stock exchanges. Exchange-traded funds, ETFs, baskets of securities like stocks or bonds that track an index or sector, offer diversification and liquidity. Traded on stock exchanges. Security refers to any financial asset that are traded, like stocks or bonds. They are purchased and sold on stock exchanges, where their prices are determined by forces such as supply and demand, providing a fair, transparent, efficient platform to trade such securities. Who invests in stock exchanges? Banks, insurance companies, pension funds, hedge funds, mutual funds, and retail investors are the main investors in stock exchanges. Below are more details about the six banks. Banks invest in stock markets for multiple reasons, including generating income through trading activities, providing liquidity to their customers, and managing their own portfolios. They also utilize stocks as part of wealth management services, whereby they help clients to oversee their own investments. Insurance companies. Insurance companies utilize stock markets as an avenue to generate income and manage risk. Insurance companies could potentially receive higher returns while spreading risk more evenly among investments by diversifying their investments over multiple companies and industries. Pension funds. Pension funds invest in stock markets as a method for both income generation and asset growth in the long term. Stocks prove to be an appealing source of growth potential and income production given their long investment horizons. Hedge funds. Hedge funds are investment funds that utilize strategies, such as stock investing, to generate high returns. Hedge funds use leverage or derivatives to enhance these returns further while taking more risks than conventional funds. Mutual funds. Mutual funds are those passive investments made by traders. They are managed by fund managers, and traders only need to keep an eye on it when it reaches its maturation period. They will have present portfolios, and their funds will be invested in the stock market based on certain criteria. There are different types of mutual funds in the market. Retail investors. Retail investors are the largest group among the mentioned. They are individuals who buy and sell stocks in the stock market directly. Investors are drawn to stock exchanges because of the promise of high returns and diversifying portfolios with various security types in stock market. But investing in stocks carries risks too, such as market volatility and potential for losses. So investors should conduct extensive research before making investment decisions. What are the stock exchange physical features? The physical characteristics of stock exchange facilities will depend on their specific nature and location, but certain elements are typically present across most facilities. An essential feature is a trading floor, the area in which trading activity takes place. This area may be broken up into different sections or pits that specialize in certain securities trading activities. They also have electronic display boards that display real-time market data, and there is also information present on this surface. Trading terminals, the electronic devices traders use to buy and sell securities, are an integral component of trading systems on exchanges. They come in various forms, such as computer workstations or handheld devices connected directly with exchange trading systems. Stock exchanges also often offer dedicated rooms for holding initial public offerings, IPOs, and other securities offerings, complete with presentation tools to assist the offering process. Stock exchanges also typically provide offices for brokers, traders, and other market participants to facilitate trading activity. These offices could include phones and fax machines for ease of communication between traders. How do buying and selling happen in the stock exchange? Stock exchange trading involves placing orders to acquire or dispose of shares of publicly traded companies on an exchange. A stock exchange serves as an intermediary between buyers and sellers that facilitates these transactions to ensure liquidity and efficiency in the market. Purchasing refers to the acquisition of shares of a company in hopes that their value will rise over time, while selling refers to disposing of them with an eye towards realizing gains or mitigating losses. Traders can take a long position when they are about to buy shares and a short position when they are selling them. The buying and selling of shares takes place based on the demand and supply of the market. Traders take the long position when they expect the prices to rise, and they rise when demand increases, and vice versa happens. Trades take short positions when prices go low. Investors have several orders at their disposal when buying or selling shares, such as market orders, limit orders, and stop orders. Market orders will always be executed at the best available price, while limit orders must meet or surpass specified minimum prices, while stop orders trigger when an exact threshold price has been reached. Orders are matched through either an electronic trading system or human brokers on a hybrid exchange's trading floor, a matching process that matches each order type with buyers or sellers depending on price and type. What are the main benefits of the stock market? The stock market is an ever-popular investment choice among both individuals and businesses alike, offering investors high returns, liquidity, and portfolio diversification benefits. Here is a list of the key advantages associated with investing in the stock market. Potential for high returns on investment. Stock market returns have long outperformed other asset classes over long time spans, offering investors the possibility of high returns through capital gains and dividends. Liquidity. Investors find it simple and cost-effective to buy and sell stocks on the stock market, which provides liquidity. This makes switching positions simpler than ever. Portfolio diversification. Investing in the stock market allows investors to diversify their portfolios across various companies and sectors, which helps reduce risk. Access to capital. Companies raise funds through issuing stocks and bonds on the stock market, giving them access to the necessary capital to invest and expand their businesses. Increased public awareness. Being listed on a stock exchange raises the public profile and awareness for your company, helping with marketing and partnerships. Economic growth. Stock markets support businesses by encouraging entrepreneurship, leading to job creation and overall economic development. This bodes well for our economy as a whole. Global trade. Stock markets enable international investments to cross borders more freely, which promotes global trade and connects the global financial system, thus reinforcing international relationships and interdependence. Technological innovation. The stock market fosters investments in innovative companies, which lead to technological progress and productivity gains for the overall economy. Individuals and businesses alike can support technological innovation, economic growth and job creation while diversifying their investment portfolios by investing in the stock market while possibly earning significant returns on their investment portfolios. How does the stock market affect macroeconomics of a country? A strong stock market has a profound effect on a country's macroeconomics, influencing key aspects of its economy. A well-performing market stimulates consumer spending due to an increase in wealth effect as investors' portfolio values increase. This in turn drives economic growth, creating positive macroeconomic conditions. Stock markets provide companies with a method for raising capital that supports investments and expansion projects, resulting in job creation and economic expansion.